Welcome to Whitefield's 101st full year update covering the 12 months ended 31st March 2024. I'm Monica Knight, and today I'll be talking with Whitefield's Managing Director Angus Gluskie and Director Will Seddon. Whitefield has reported an operating profit after tax of just over $20 million for the year. This result equates to earnings per ordinary share of 17 cents, an increase of 10% on the year prior.
Yes, it was encouraging to see continued growth in the dividends across our investment portfolio as the year progressed. This is consistent with the Australian economy's resilience at this time, a characteristic that has surprised many economic forecasters. So some of the more notable contributors to earnings growth in the year were the major trading banks, insurers IAG and QBE, energy retailers AGL and Origin, as well as Computershare, Helia Group, Super Retail Group, Carsales, Pro Medicus and Flight Centre.
Costs and tax also influence net profit. Can you comment on those, Angus?
On the cost front, operating expense growth was contained to 2%, while tax expenses rose slightly as a result of the higher proportion of unfranked income earned by the company. So the ratio of total operating expenses to assets for the year amounted to 0.44%.
Whitefield has declared year-end dividends of 10.25 cents per ordinary share and 131.25 cents per preference share. All dividends are fully franked and will be payable in mid-June. The company has now maintained or increased the ordinary dividend for over 30 consecutive years. What's the policy for this looking forward?
So our overarching policy is to pay a dividend that is similar to our operating profit and the average level of realised, but not unrealised, capital gains, subject to the smoothing of those dividends from year to year. This has meant that we've been able to provide investors with a smooth, consistent dividend through the last two market crises, being the GFC and the recent COVID years. Once we achieve a further leg of underlying earnings growth from the company's portfolio, we will be positioned to consider increases to our own dividend. We're getting increasingly close to that point, but those decisions will depend in part on economic activity and the state of investment markets.
Now, Will, equity markets rallied very strongly into our March year end.
Yes, they did, and we saw this reflected in Whitefield's investment portfolio return of 19.9% for the full year. A primary reason behind this rally was the emerging awareness among investors that Australian and global economic conditions were more robust than many had feared, despite inflation continuing to ease. In particular, consumers in Australia and the US have so far been able to absorb the higher level of interest rates, supported by rising wages, strong employment, and cash reserves accumulated through the COVID years.
And how did Whitefield's portfolio perform relative to its benchmark index?
Portfolio returns currently sit very close to benchmark over the 1, 3 and 5 year periods, and moderately ahead over the longer 40-year timeframe. Notably, the portfolio performed very strongly relative to benchmark over the last 6 months.
And Will, what were the best performing investments in the year?
Strength of return was spread across a wide range of sectors. Within industrials, James Hardie, Boral, Seven Group and Goodman Group generated strong returns. Healthcare and technology companies also contributed, including Altium, Pro Medicus, Xero, Life360 and WiseTech. And consumer-exposed businesses such as Carsales and JB Hi-Fi continued to perform well as well.
Inflation seems to be a key consideration for markets at present. What's the outlook for inflation going forward?
We expect inflation in the current decade to be higher than it was between 1990 and 2020. Over that period, inflation was low as companies shifted manufacturing to low-cost regions and there was significant liberalisation of markets and trade. Many of these tailwinds are now slowing or reversing, accompanied by a propensity for employees to seek higher wages to cope with rising living expenses and also house prices. We also expect to see more government involvement with business as society seeks to solve pressing problems such as wealth inequality and climate change. And these actions, while desirable, will come at a cost, and this too will contribute to inflation.
Is this good or bad for equity markets?
Well, the level of inflation is one way that economies can rebalance to bring incomes to sustainable levels compared to assets and debts, without falls in asset values. And while investment returns are volatile by nature, historically outright returns for equity markets have been reasonably strong over periods of higher inflation. In fact, it's been very important to be invested in equities during periods of higher inflation to preserve the value of one's wealth in comparison to cost of living.
And Angus, assuming we're going to see an environment of higher inflation over the next decade, growth assets such as shares may be important for investors?
So, in a higher inflation environment, shares provide investors with exposure to businesses whose revenue, profit, and asset values are likely to inflate over time, driven by both inflation and general economic growth. So that characteristic can be hugely important. For example, Whitefield's earnings per share, being our earnings from our underlying investment portfolio, are 37 times higher today than they were in 1970. And Whitefield's asset backing is 47 times higher over the same period. So you can see that investors in Whitefield in turn have been able to receive dividends and have their experience asset value growth that has more than kept pace with inflation over those years.
Okay, that's significant. That brings us to the end of our full year update. We'll look forward to reporting on our 2024-25 year over upcoming months. For more information on the company, please refer to our website at whitefield.com.au.